Hello, my friends. Today is November 16th, and this is Markets Weekly. So, this past week, we got quite a bit of volatility. Looks like it was largely driven by November options expiry. Is this just a bump in the road, or is it all over? We'll find out in the coming weeks. But today, let's talk about three things. First, even though the broader indexes didn't do that well the past week, there are three Trump trades that continue to surge. Let's talk about what they are and why they continue to do well. Secondly, the past week, President Trump, Elon, and Vivek unveiled DOGE, Department of Government Efficiency, that promises to cut government spending and government personnel. Let's talk about what that can mean for the broader economy. And lastly, last week, Chair Powell had an interview where he suggested that he would change the Fed's operating framework. Let's talk about what the current framework is and why it makes sense to change it at the upcoming Fed review. All right, starting with the Trump trades. Now, there are three Trump trades that really caught my eye the past week because they continue to be on fire. First, of course, Bitcoin. Looks like it was up every single day. It's around 90,000 right now. Looks like it wants to go higher. What is driving this? Well, President Trump, in a memorable fashion during the campaign, went to a very large Bitcoin conference and made a lot of really bullish remarks, wanting to make the US a crypto leader. Now, among his proposals, having a Bitcoin reserve fund, loosening regulation, and more recently, floating some tax proposals that could eliminate capital gains tax for some crypto assets. Now, all in all, this sounds super positive, so it's no surprise that Bitcoin continues to go up. Although looking more in detail, it does seem a little bit, I think, perplexing. For example, just what would a Bitcoin reserve fund be used for? Now, the US has a strategic petroleum fund, reserve fund, because the US consumes a lot of oil. Other countries have dollar reserve funds because they need to spend dollars to buy goods and services that they import. Now, I'm not quite too sure what the Bitcoin reserve would be used for. There are use cases for Bitcoin. Right now, it seems to be mostly number goes up, which it does very well. So it's not super clear what we would need a Bitcoin reserve fund. But if there is one, again, that's more demand for Bitcoin, prices go up. Now, the other two proposals do make a bit more sense. Now, the US, I think a big challenge for any adoption of an alternative asset like Bitcoin is the regulatory regime. Now, SEC Chair Gary Gensler is often considered to be someone that's not as friendly to crypto. It looks like he's on his way out. Now, if we have someone new coming in, we could have a new regulatory regime that is much more friendly. Now, when Bitcoin Cash ETFs came out, that generated tremendous enthusiasm. It was easier for the public to buy Bitcoin, and that really made the number go up. And so if we have even more friendlier regulatory regime, that's obviously helpful for the price. And then lastly, the recent proposals about, I think, reducing capital gains tax for crypto assets, that seems a bit more ambiguous. It seems like what's hinted right now is that in order to support the development of a US crypto industry, they'd like to have no capital gains on US issued crypto, which I'm not sure Bitcoin is, but it is quite positive for the broader crypto ecosystem. Now, all these proposals, I don't know if they will actually amount to anything, but just having this in mind is capturing the imagination of people. And as President Trump picks out his cabinet, as he gets closer and closer to being sworn into office, this could potentially continue as these regulations do, in fact, would be, I think, beneficial to Bitcoin and the crypto industry. Now, moving on to the second really on fire Trump trade, it's the dollar. The dollar looks like it's just going straight up. Now, the biggest part of the dollar basket obviously is the euro, and the euro has been really weak. Now, we talked about this last week, but a big part of the ongoing dollar strength is twofold. One, of course, is the market's perception that the US is going to have more growth, so we have money flooding in to try to take advantage of the greater growth in the US. Again, US markets doing very well. Foreigners want to participate in that price appreciation. But the other side of this is the prospect of tariffs. Now, looking at the European Union, you can see that over the past few decades, the US has a tremendous trade deficit with the European Union, and that's going to annoy President Trump a lot. Now, there aren't that many solutions to fix this. So Europe, like the US, is a very complicated political system with all sorts of interest groups, and they're not going to want to change. The easiest way for them to try to narrow the deficit is to just buy more US goods, probably US defense goods, since that would also make Trump happy about their spending on defense. But in any case, the first instinct of this is probably more tariffs to try to encourage the Europeans to be more receptive to changing their trade practices. And this, of course, is bad for the European economy and is forcing the the ECB to probably cut rates more. And if you look at the interest rate differentials between the US and the European Union, over the past month, we see the US price in fewer rate cuts as they become more positive on growth prospects, and over there in Euroland pricing in more rate cuts as they become a little bit more pessimistic. And so the interest rate differential is widening, leading to a stronger dollar. This looks like something that could continue, especially if President Trump really does carry through with his aggressive tariffs. Now, this is not just a story between the US and the EU, it's also a story between the US and other countries like Mexico, Canada, China, and so forth. So it looks like a broad dollar strength does make a lot of sense given the current policy proposals. Now, the last thing that really caught my eye among the on-fire Trump trades are US financials. Now, the US banking stocks are doing really well. Now, what really stood out was Wells Fargo. It looks like Wells Fargo going straight up like it thinks it's Bitcoin. Now, the financials, the banks in the US, since the great financial crises, have been under a very heavy regulatory hand. In many ways, they're kind of like utilities. They're highly regulated because, understandably, the regulators don't want a repeat of the great financial crises. But the prospect of more lenient regulations means that they can continue to make more money, make more loans, and that's really positive for the banks. Now, it's particularly positive for Wells Fargo because Wells Fargo is operating under an asset cap. As many of you remember, Wells Fargo behaved very, very poorly over the past decade. Many reports of fraudulent accounts being opened. And as punishment for that, they were put under an asset cap. That means that they cannot expand their balance sheet. They cannot really limit their ability to make loans. Now, if you take that asset cap off, then they can continue to grow, and that's tremendously positive for their stock. So, broadly speaking, if the financials get less regulation, they can continue to expand, increases their earnings. It makes sense for them to do well. And if they continue to expand, that's actually quite positive for the US economy in general, because that means more availability of credit. If you want to get a mortgage, if you want to get a credit card loan, if you want to get an auto loan, it's going to be more available. So strength in financials is actually quite bullish, not just for the banks, but for the US economy in general. Now, all this is based upon what the market believes that the upcoming Trump administration will do. This can all change. Let's not get ahead of ourselves. But so far, it seems like all this is consistent with what Trump did his first term and what he's been saying for the past several months. So let's see how this plays out. Now, the second thing I want to talk about is DOGE. Now, Elon has been really making a lot of noises about his concern about government efficiency. He's been saying that there's just a lot of waste, fraud, and abuse in the government, and that he wants to tamp down on this. Vivek has also made some noises to this, famously noting that just kind of fire everyone who has an odd number, social security number, or something like that. Now, these guys are big on efficiency. They've been in the private sector a long time. Elon famously fired, say, large majority of the Twitter staff, and Twitter's still here. So he is known for being a bit more efficient. President Trump finally affirmed this by making an advisory body, again, not an official agency in the US government. I believe you need an act of Congress to do that, but making what is essentially an advisory board led by Elon and Vivek. Now, a lot of you have not worked in the government before, so you may not be familiar with how this works, but I worked in both the private sector for many years and in the public sector as well. So I can tell you that this is actually a really good thing. So now, when I started my career in the private sector, I started at a law firm and I worked under a law partner. Now, at that time, I didn't know anything. And so everything I did was reviewed by the law partner or the senior associate. And those guys, they've been doing this their whole life, would absolutely smoke me on any aspect of the law. And I learned a lot from them. I've also worked in an economic consultancy under a PhD economist. Remember my boss then got his PhD from MIT, and everything I did, subject to his review, learned a lot from him. When I was a credit analyst, I worked under someone who's been in the industry for basically almost 20 years, and he knew all the issuers, he knew the structure, he knew the asset really well, and everything I did was reviewed from him and um, reviewed by him, and I learned a lot. So that's actually how the private sector operates, and many of you are familiar with that. What you may not know is that's not actually how the public sector operates. So when I went to the Fed, a lot of people there were very smart and knowledgeable. I learned from them. But what really struck me was just how clueless many of the leadership and the management of these organizations are. Now, somewhere towards the end of my tenure at the New York Fed, we got a new senior management, and I remember meeting with her, and she candidly said that she did not know really anything about money markets, which is what I specialized in and what she was supposed to lead. But she's happy to learn, and that really struck me because just a couple weeks ago, the college intern told me the exact same thing. And so for the coming months, it was basically the job of me and my team to make this very senior person appear to be competent. And let me tell you, you can't coach IQ. And what really struck me being in the public sector for those years was that there were many, many people like that. And it really surprised me because how could this work, right? And then I understood it could work because the public sector is ultimately a business that can fail, run by people who can't get fired. Nothing matters. So you can just do a terrible job. You can do nothing, and really nothing bad happens to you. I can say during my time there, I was there 5 years, only one person got fired. And she was someone who really just didn't feel like showing up to work. Sometimes she would come to work, sometimes she wouldn't. Sometimes she would do her work, sometimes she wouldn't. And after many months of this, she was finally fired. So the public sector is really different from the private sector because you can never get fired and nothing matters. And that kind of breeds tremendous amounts of incompetence and mismanagement. So I think this government agency idea is really good. Now, if you look at the numbers, now the Government Accountability Office in the US has come up with a number that the US federal government is, a victim to between 250 billion to 500 billion a year in just straight up fraud. I mean, think about what happened during COVID, for example. PPP loans just given out, and no one really knows what happened to the money. So having more accountability and a smaller federal government does make a lot more sense. Now, I'd also add that some of the people in government, they're really trying to do a good job. But at the end of the day, if you can't get fired and you just continue to rise up in the ranks, then in a sense, you basically own the government agency. Some of these people trying to do a good job to benefit the public, but there are also bad people who basically run it like their personal piggy bank, just finding ways to game HR rules to give themselves promotions, promote their friends, and just straight up use the agency as a piggy bank. So being able to have more accountability, a smaller, leaner government, is basically a way to root out corruption and fraud and mismanagement. So this is something that I think is broadly something that many people know is a problem and that people have tried to fix for many years. I mean, it's really hard though. Even during Bill Clinton, when they tried to have some degree of government reform, it was very difficult because there are so many interest groups involved. It's a very difficult uphill battle. But assuming that this does get rolled out though, I think that on the short term, it's not going to be good for economic growth because you are essentially you're essentially reducing workers, and workers don't have money, they won't be able to spend, and so that's a little bit less demand. But I think in the longer run, though, this is actually quite a positive development because when all these guys get kicked out of government, they don't disappear. They go and they find jobs elsewhere. Ideally, jobs where they are actually be able to do things other than just look at funny cat pictures. So again, you're increasing the productivity of the United States economy in the long run, and you're also cutting the deficit, which, as many of us know, is just not sustainable. So this is something that looks like it's going to be short-term pain for long-term gain. If they're able to do it, hopefully they will. But it's a struggle. If it can ever happen, it's going to be now, because at the moment we really do have more of an outsider force where all these people that I think many of the establishment people don't like are running the show. Okay, the last thing I want to talk about is about the Fed's framework. Now, Chair Powell gave an interview the past week where he talked about how the Fed is probably going to revise their operating framework.
I won't go into all the details, but it was to have a make-up strategy so that we would promise ex ante to let inflation run a little bit high if it were running too low. And the thought was, if people believe that you'll do that, if that's credible, then inflation won't run low. So that's all we did.
So what does that mean? So the Fed, as we all know, has two mandates: price stability and full employment. Now, the operating framework is basically how they go about carrying this out. In 2020, the Fed was basically experiencing about 20 years of pretty low inflation, and the great problem it was thinking about was how to get inflation higher. Now, with that in mind, it modified its operating framework in two important ways. One is it committed to asymmetric, flexible average inflation targeting. And what that means was that it aspired to have inflation that was 2% on average over time. However, if inflation ever undershot, it would let inflation stay above 2% for some time to compensate. If inflation ever overshot, it would not compensate by letting it undershoot for a period of time. So it was asymmetric in the sense that inflation could be higher than 2%, and that would be fine. But if it ever became too high, they would not commit to being able to kind of undershoot. So that was aimed at trying to move inflation expectations higher. So if you are the Fed, you think of the world through the lens of inflation expectations, thinking that if the public expects, say, inflation to be 2%, then what would happen is that inflation would magically be 2%. And you see other central banks think about this the same way. Bank of Japan, of course, memorably raised their inflation target some years ago to try to get inflation up. Didn't work because while inflation expectations is important in determining actual inflation, it's not really shaped by what the central bank says. It's largely shaped seemingly by the everyday experiences of the people. In any case, that was one major change to the Fed's framework. The other major change is a commitment to not hike rates preemptively when the unemployment rate became too low. Now, historically, if the unemployment rate became too low, the Fed would be worried that the economy is overheating and hike rates preemptively to try to get ahead of potential inflation. The Fed committed to not do that anymore. Now, these two changes to the framework were done in a world where inflation was low. And so that was a time where the Fed, just wanted to get inflation up. But now today, it's a very, very different world. We are in a world where looks like their interest rates are about, going to be 3-4% or 5% for the foreseeable future. We're going to be comfortably above a zero lower bound. And it's a world where, inflation might be a problem in the future. Now, in that world, we don't really need these two changes to the framework. We could probably run monetary policy more or less how we ran it before 2020. And that is to say, we don't try to goose inflation expectations upwards. So
the base case should be more like a traditional reaction function where you don't promise an overshoot, you just target inflation. We haven't made any decisions, but those are the questions we'll be asking.
Maybe we just abandon this asymmetry there. And, maybe we could think about just kind of preemptively raising the funds rate when unemployment rate is too low. Now that I'm not too sure they will do, but I'm pretty sure they're going to abandon the asymmetry and the flexible inflation targeting. And who knows, there could be other changes as well. Some of the things floating, having an inflation band, where let's say the Fed's target was a band between 1.5 and 2.5 or something like that. Again, the problem they're facing today is higher inflation. So that's going to fundamentally change the operating framework. And Chair Powell has told us one way that it will change. Okay, so that's all I prepared for today. Thanks so much for tuning in. Remember to like and subscribe. And if you're interested in hearing my latest thoughts, check out my newsletter, fedguy.com. Talk to you all next week.